Everyone, while prescribing a new format for statement of profit and loss account in the Companies Act 2013, three new concepts were introduced. They are profit and loss from exceptional items, profit and loss from discontinued operations. We have already discussed the concept profit and loss from discontinued operations via my previous video number 116. Let us now discuss profit and loss from exceptional items via this video. The topic to be covered in this video are introduction of new concepts in the statement of profit and loss account, exceptional items definition, exceptional items income and expense, examples for exceptional items, why identifying exceptional items is important in credit appraisal. Exceptional items are income or expenses from ordinary business activities or from events outside ordinary activities that are unusually large or infrequent, requiring separate disclosure to explain the company's performance. Exceptional items are unusually large in amount, may be or may not be part of the normal business operations, but do not occur every year. It is infrequent. Exceptional items can further be classified into exceptional income and exceptional expense. Exceptional items are unusually large in amount, may or may not be a part of the normal business operations. Classification is contextual, not mechanical. Say rupees 20 lakh loss may be exceptional for a small company. Rupees 20 lakh may be immaterial for a 500 crore turnover company. Now, profit on sale of the division. Exceptional income, not a part of normal business operations. Receipt of a bulk one-time export order. It is an exceptional item, exceptional income, part of normal business operations. And relocation expenses. It is an exceptional expense not related to normal business operations. Loss due to a major fire in a factory resulting in production loss. It is an exceptional expense but related to normal business operations. So the exceptional items can be related to normal business operations or may not be related to the normal business operations. Let us look at some practical examples. Profit on sale of a large factory land. It is exceptional item, yes, unusual and significant. Regular scrap sales. It is not an exceptional item, but it is a part of the ordinary activity. Major restructuring cost. Rare, but from business activity, it is an exceptional item. Small penalty paid. It is not material, so it cannot be classified as a exceptional item. How bankers use this information, that is a credit appraisal insight. Bankers often exclude exceptional items while assessing sustainable profitability, repayment capacity, cash generation ability, because these items may not recur in future years. In banking and credit appraisal, exceptional items are often noticed because they distort the normal profitability of the business for that year. Bankers usually isolate them to understand the true operating performance. Whenever income arises from selling assets, compensation, legal settlements, or accidents, it improves the P&L temporarily but doesn't improve the business. A credit officer must look at the operating profit after removing such exceptional items. Exceptional items in financial statement. Understanding exceptional items is crucial for transparent financial reporting under Schedule 3 of the Companies Act 2013, especially in the statement of profit and loss. Disclosure shown separately in P&L within the relevant head or as a distinct item. Notes must disclose nature of the item and the amount involved. Important update. Under Ind AS and revised Schedule 3, extraordinary items no longer exist. All items are now classified as ordinary or recurring items and as exceptional items if unusual or material. Exceptional items are not a separate head of income or expense. They are shown separately within the statement of profit and loss after arriving at profit from normal operations. It is a placement in the statement of profit and loss. There is no numerical threshold like rupees 10 lakh, rupees 1 crore or 5% of the profit, etc. There is no prescribed amount to classify an item as exceptional. The decision is based on materiality and nature, not on a fixed monetary threshold. Key concept: materiality. The guiding principle is materiality. Materiality depends on size relative to profit, impact on EPS, impact on net worth, nature of transaction, user decision making relevance. Conceptual structure in simple formula: operating profit plus or minus exceptional item, which is equal to profit before tax, deduct tax, profit after tax. Examples are profit on sale of surplus land. A manufacturing company sells an unused land parcel and earns rupees 3 crore profit. This profit does not arise from manufacturing activity, so it should be ignored while judging operating profitability. Profit on sale of old machinery or factory building. If a company sells an old plant and earns a large one-time gain, it is non-recurring and not part of normal operating earnings. 3. Insurance claim received for fire accident. A factory receives rupees 2 crore insurance compensation after a fire accident. This is a compensation, not a result of business efficiency. 4. One-time legal settlement received. Company wins a court case and receives heavy damages from a supplier or contractor. 5. Large foreign exchange gain due to currency fluctuation. If a sudden depreciation of the rupee creates a one-time large gain in export receivables, it may distort the true operating margin. 6. Government compensation subsidy received once. For example, compensations received for land acquisition or relocation. Voluntary retirement scheme compensation. A company may introduce a VRS to reduce surplus manpower and pay a large one-time compensation to employees. Example, a manufacturing company pays 8 crore as VRS compensation to employees. Related to normal business, employee management, but large and non-recurring, so it is reported as exceptional expense, VRS compensation. 2. Planned relocation expense. A company may shift its factory to another location due to environmental regulations, expansion, or cost advantage. Expenses may include dismantling machinery, transportation, reinstallation cost. Example, rupees 5 crore spent on shifting plant to a new industrial area. This is shown as exceptional expense, planned relocation cost. 3. Major asset impairment. If machinery becomes obsolete due to technological change, the company may write down its value. Example, a textile unit's writes off 10 crore impairment loss on outdated machinery. This is an exceptional income because such large write-downs do not recur regularly. Loss bar due to major accident fire. A large fire accident, flood, or explosion may damage inventory or plant. Example, inventory loss of 3 crore due to fire not fully covered by insurance. This is reported as exceptional loss. One-time legal settlement. A company may settle a long pending legal dispute. Example, payment of rupees 4 crore to settle a commercial dispute with a supplier. Since it is a one-time and unusual, it is shown as an exceptional expense. 6. Restructuring cost. When a company recognizes or reorganizes its business divisions, it may incur closure of a unit, employee termination compensation, restructuring advisory fees. Example, 6 crore restructuring cost. This is also reported as exceptional expense. Thank you. I'll come out with such small videos on lending topics. Subscribe to my YouTube channel, NP Iyer's Learning Modules in Lending, and click the like button, which enables you to get notifications whenever a video of mine is uploaded. Follow me on Facebook and on Instagram.